This is the Growth and Value Podcast, empowering and inspiring stock investors, helping you take control and make a difference with your investment dollars. Looking for quality stock tips? Well, we may or may not be talking about Apple. We may or may not be talking about Google. We may or may not be talking about Disney. However, since we use our proprietary algorithms to screen, analyze, and rank over 6,000 stocks every week, we will be talking about timely investment opportunities. So you may often hear the name of a company you haven't heard of before, and you know what? That is often the best kind of opportunity, an opportunity to get in early before the investing masses. The Growth and Value Podcast is made possible by Connor Management Group, a registered investment advisor firm. Hi everyone, Mathis Connor here with Connor Management Group, and this week we're going to look at the best overvalued stock to sell right now. Today is Tuesday, January 27th, 2015, and here on the opening slide we see that this stock is in the medical instruments and supplies industry, and we see its 6-month downside potential at negative 27.6%. On to the next slide, and we see that the name of this company is called Thoratec Corporation, and their ticker symbol is THOR, Thor, and this company is in the medical instruments and supplies industry, and once again we see this company's 6-month downside potential at negative 27.6%. On to the quick facts slide. We have two business descriptions once again. Here's one. Thoratec Corporation is a global leader in cardiovascular therapy. The company manufactures and markets pneumatically driven and electronic ventricular assist devices for congestive heart failure patients and operates clinics and health centers. Their foreign sales in 2013 were 22% of their total sales. The more lengthy business description we have is Thoratec Corporation develops, manufactures, and markets proprietary medical devices used for mechanical circulatory support for the treatment of heart failure patients. The company's primary product lines include ventricular assist devices such as HeartMate 2, an implantable left ventricle assist device consisting of a rotary blood pump to provide intermediate and long-term mechanical circulatory support. And they also manufacture the HeartMate XVE, an implantable and pulsatile left ventricle assist device for intermediate and long-term mechanical circulatory support. So basically this company makes heart pump devices. So this is what they do, and let's see. The website for Thoratec is www.thoratec.com, just like it sounds, THORATEC.com. Thoratec is headquartered in Pleasanton, California. They were founded in 1976, and they only have 951 employees. So from an employee standpoint, this company is smaller than most of the companies we've looked at. Once again, the ticker symbol is THOR. They operate in the healthcare sector, and within the healthcare sector, they operate in the medical instrument and supplies industry. On to the products and services slide. We don't have too much here. We basically have the Thoratec Corporation logo, and we also have an excerpt from their website. It shows a picture of their device and a picture of the human heart. It says the only blood pump proven to work longer than ours. That's the heart. And then it says, but we're getting closer. And then there's another image of their leading product, the HeartMate 2 left ventricular assist system. Basically, it says more than 17,000 implanted, with 7,000 currently on support, and is available at over 365 medical centers worldwide, studied in over 400 publications, making it the most extensively studied left ventricle assist device in the world. On to the metrics slide. So for Thoratec, the annual revenue over the last 12 months was $478 million. The net income was $52 million, and the cash from operations was $91 million. So cash-wise, this company is on the small side compared to what we've looked at in the past. The operating margins in 2013 were 31%, pretty healthy. The operating margins for 2014 are tracking to be 33%, slight increase from 31 up to 33%. Onto the valuation metrics. The trailing PE ratio for ThoroTech right now is at 26.4, and the forward PE ratio is at 30.6. So from 26.4 to 30.6, that implies that analysts expect their earnings to decline a bit over the next 12 months. The PEG ratio for ThoroTech now stands at 3.4, which is a bit rich. Similarly, its price-to-sales ratio is at 4.3, and its price-to-book ratio is at 3.1. Additionally, the company's enterprise value to EBITDA ratio is at 8.7. So all these valuation metrics are somewhat rich. I mean, you expect a somewhat rich valuation metric for a premium device that likely has patents on it and a few competitors. But right now, to us, this company seems a bit overvalued, and these valuation metrics seems to be a bit stretched. On to the next slide, we have a price chart for ThoroTech, and basically what it shows is that over the past 12 months, the price of ThoroTech is up 5.6%, and while it is up 5.6% over the past 12 months, it has been a roller coaster of a year. The stock started out around the $34 level about 12 months ago, and then it pulls down slightly to around $33 6 months ago, around mid-July, and then from that $33 level, it took a very hard and fast drop down to the $23 level. So it went from about $33 to $22 and less than a week. And the reason for that was simply a disappointment in earning results. They met earning results about 6 months ago, but they fell short on sales, and that just made some investors quite a bit skittish, and so the stock consequently pulled back significantly. However, since that $23 level about 6 months ago, the stock has steadily pulled up and increased back to the $36 level, now around $37 where it is right now. But in our analysis, we believe that this stock is currently overvalued. On to the next slide. For a change, we have a new slide here that tries to drive home the drivers of our view, and we call this slide the why now, the bear rationale. So essentially, for most companies, we believe that the reasons for a stock to go down in this case is related to really simply just 5 factors. They can all be boiled down to 5 factors, no matter what the story. And it's not necessarily rocket science, but number 1, decreasing in sales and revenue. There expects to be a decrease in sales and revenue. Increasing expenses, increasing capital expenditures, and for those of you who don't know accounting, capital expenditures are different from expenses, but they both require a company to spend money. Additional reason, the 4th one we have for why a company has a bearish outlook could be the emotional overbuying. What happens sometimes is that people just keep buying the stock, and the stock gets to very high valuation metrics. They get to valuation ratios that have not existed historically, and consequently the stock just seems to be very overvalued. An additional reason why a stock can have a bearish outlook relates to the change in capital structure. There are really kind of 2 reasons related to that. one thing that happens sometimes is that a company will issue new shares. So existing shares will essentially have less value. So that can cause a bearish outlook. And additionally, a change in debt can cause a bearish outlook. A company can have no debt, and actually some debt actually helps a company's financials, but after a certain point, and it varies from industry to industry, too much debt actually starts to hurt the company. So what do we have for ThoroughTech? Well, for ThoroughTech, the company is facing increases in expenses as they try to roll out and develop new products. Similarly, they're facing increases in capital expenditures. They are still growing in sales. However, the sales growth rate is slower than what's been expected, and it turns out that they're facing headwinds from some competitor products that have a smaller footprint and geometry for the heart pump products. So consequently, the company is spending additional monies on development right now, which is pushing expenses for the next 12 months, pushing capital expenditures for the next 12 months. Additionally, the stock get pulled back and it's advanced. It is now up 5% over the year. So we also believe that this stock has a bearish outlook because there's been emotional overbuying. So of those 5 reasons for our bearish outlook, we believe that ThoroughTech has a bearish outlook because of increasing expenses coming around the corner, as well as increasing capital expenditures, and there's just been emotional overbuying. On to our summary slide. Despite those points, the financial statement quality of ThoroughTech we consider to be very good. The operating margin trend, as we mentioned, has been increasing, and the price pattern trend has been increasing as well. I mean, it was a roller coaster of a ride, but the stock is up 5% over the past 12 months. Right now, overall market outlook is a bit bearish. Basically, we see some companies are missing earnings, mostly related to the strong dollar. So a lot of companies that have foreign subsidiaries and are earning products overseas because of the exchange rate, they're earning less money on a net basis, and that's all foreign exchange related. And that's just a broad brush that we're seeing. Nothing extremely bearish, but just slightly bearish. Back to ThoroughTech. The recent closing price for ThoroughTech was $37, and our 6-month price target for the company is $26.80. So that's what gives our view of ThoroughTech having a 6-month downside potential of negative 27.6%. So it's for all these reasons that we believe that ThoroughTech Corporation is the best overvalued stock to sell right now. We hope you enjoyed this presentation, and we'll talk to you again soon. Take care. Bye. Hi, this is Mathis Connor from Connor Management Group, and I just wanted to take a few more minutes to give you some background about myself and Connor Management Group. First of all, if you enjoyed this podcast, and I hope you did, and you have been over the past few months or so, please write us a review on iTunes and Stitcher. We really would appreciate it, and it would help us get more subscribers. So that's something we'd appreciate. So for the podcasters out there, please go to Stitcher or iTunes, and for you guys on YouTube, I'd appreciate a thumbs up and like, as well as just becoming a subscriber to the CMG Stock Picks channel. All right, well, that's what I wanted to say with regard to the podcast and YouTubers. Hey, try to be efficient. But I wanted to share a little bit about myself. Basically, I've been told from some friends and listeners that know me that I could enlighten my audience with a little bit more about myself. So I'm not all that comfortable with telling about myself. I really kind of want you to enjoy the content. But for those of you that have an interest, this is why this stuff is all the way at the end. So, okay. My name is George Mathis Connor. My background is that I have a bachelor's in mechanical engineering from a place called Rensselaer Polytechnic Institute, engineering school in upstate New York, a master's in engineering from Cornell University, also in mechanical engineering, and I have an MBA in finance from the University of Chicago. So hey, that takes care of my educational background. Basically, bottom line is to see, I did a lot of schooling. What my career experience has been to date, I started out my career as an engineer, did a few years of that. Worked on a lot of cool landmark renovation buildings in New York City for a few years. One of the most high-profile ones was my company, or I should say the company I worked for, was part of the renovation team of Grand Central Terminal. So for those of you that passed through there, I've spent a number of years in and out of every cranny of that building and facility. I also worked as a banker in New York after I got my MBA. And basically, I worked on financing a lot of large-scale infrastructure projects, mostly power plants, but I worked on some basketball arenas as well, and some chemical plants, and even some coal mines. I've been deep down in the ground a number of times in my career. Additionally, let's see, after that, started working on the investment side of developing power plants, and particularly I spent most of my career with a company called Enron and another company called GDF Suez, where I worked on the development of power projects where where I acted as a equity investor for whether we were going to build them or buy them or sell them. And after GDF Suez, I am now an investment manager, and basically I've been studying deals over the years, learning to build complex financial statements, always evaluating them, the cash flows, and making sure that these things will be profitable. And investing in the stock market was always a hobby of mine that I took more and more serious over the years. So after a bunch of time, I just, I'm really going to go after this. And so I spent maybe about, 3 years actually working on the development of some proprietary algorithms. I was just convinced that with my mathematics and computer background, coupled with all these financing deals, of which I became very good in with accounting and finance, I thought that I could at least find one way of consistently finding stock opportunities. So it was the development of these proprietary algorithms and me having some success with them that led me to the development of Content Management Group and the development of all these videos and podcasts you've been seeing and hearing. And, I am pretty happy with these algorithms. Basically, they review, analyze, and rank over 6,000 stocks every week. They're pretty comprehensive and pretty thorough. The algorithms use fundamental technical analysis and also consider some macro level measures. And another thing that's pretty unique is that these algorithms estimate future stock prices with specific time horizons. I haven't seen too many people on the web that will give you a potential stock price, say consistently say this is what we expect the price to be in 6 months, or this is the price that we expect there to be in 12 months. And I think for most of the videos and podcasts that I produce, you've always heard me give a potential stock price going 12 months out. The premium subscribers actually give them a stock price for the top stock prices for 6 months out. So that's about what I have to say about the algorithms. Additionally, about Content Management Group, our primary offering of CMG LLC is that we are a managed account service. And basically, a managed account, for those of you who don't know, is basically a more hands-on, customized way of investing for the long term. It's basically a complement or a supplement to 401k or IRA and it has more benefits. And basically, you probably haven't heard of these as much or over the years because they've just become a lot more available to middle-class investors. And that's primarily because of advances in software for being able to handle many clients and move them in and out of custom portfolios and options. So if you want to know more about our managed account business, please go to CEOConnorMG.com. That's www.connormg.com, or you could go to our website and you can see a presentation that compares kind of management groups side by side with other managed account providers. E-Trade provides managed account service, Fidelity does, a lot of other mainstream firms. And like we said, basically now that technology is advanced with software, it's a lot easier to manage. So basically, as with E-Trade's, a minimum size of account we open, say $25,000. And while as I'd say 10 years ago or more, minimum account size was probably $500,000. So there are a lot of changes, and you'll be hearing more and more about this account service, as time goes by. Additionally, let's see. Additionally, you can get to know us through our social media footprint. Basically, we have a presence on all the major websites for your convenience, and there you can get a lot more articles and hear about different points of view on things going on in the market. So we have a presence on Twitter, Google Plus, and Facebook, as well as LinkedIn also. So you can be kept abreast of our thinking on stock investing, as well as things we share by others who we consider thought leaders. And finally, CMG offers 2 newsletters, both weekly, 2 weekly newsletters. One is to keep investors up to date about relevant news and provide in-depth analyses on a quality investment opportunity. And those opportunities are consistent with the free weekly podcasts and videos. And the other newsletter we provide is our premium newsletter, and that one provides the latest top picks from our proprietary algorithms that we run every week. So, feel free to go to CMG stockpicks.com, and you can go there to subscribe to the newsletters. And if you go to the website, you can also view this deck and or any of the decks going forward, and there'll be a link there to everything I've just talked about. Basically, everything from the podcast to the newsletter to the presentations about our managed account service. So, hope this was helpful. Nice overview. Hope it didn't bore you. You can listen to this a couple times. That's why I put this at the end of the stock presentation. And I'll talk to you soon. Take care. Bye.